Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, February 5th. Chinese markets returned from the Lunar New Year break on a bearish note, while gold hit a fresh record high amid mounting concerns over worsening international relations under Donald Trump. The US dollar, on the other hand, eased yesterday after a softer than expected US job openings report, while Google and AMD disappointed their investors after the bell. So the Chinese markets opened for the first time after a long Lunar New Year holiday, and they opened down, of course, on a set of weaker than expected PMI figures from Caixin this week on the news of 10% tariffs on its exports towards Trump's USA, and on the back of a further escalation of the trade war with the tit-for-tat measures announced yesterday already from Beijing, including 15% tariffs on US coal and LNG imports, and also an antitrust probe into Google. But losses in the CSI 300 index remain quite measured this morning, as the 10% tariffs from the US were actually considered as being quite modest, especially compared to the chatter of up to 60% tariffs before. And while China's response to the US and its tariffs was also seen as being quite moderated. Many simply pointed out also that 10% tariffs on Chinese imports could be absorbed by yuan devaluation, and that, well, Google is already banned in China since 2010, for not censoring search results in accordance with Chinese government regulations. You can hardly heard the company more than completely banning any access from China to all of its services, actually, and that since more than a decade. Still, analysts at Morgan Stanley see a 20% downside risk in Chinese stocks should tariffs increase on computer chips and should trade tensions re-escalate. For now, though, the trade tensions-led losses remain quite limited, but does appetite in Chinese stocks as well. Across the Pacific Ocean. Well, Google hit a record high level at yesterday's trading session, and that regardless of the Chinese, threat. Magnificent Seven stocks, on the other hand, saw some strong dip buying and rebounded near 1.80%. Palantir was the star of yesterday's trading session with a 24% rally in its share price after announcing lot better than expected quarterly results, and also amassing rating and PT upgrades from big US banks on its capacity to cash in on the AI boom. Here in Europe, German Infineon also jumped 10% yesterday on the back of better than expected revenue forecast from the company due to favorable currency effects and also an expected recovery from car industry. Overall, the Stoxx 600 index was also better bid at yesterday's trading session on rising confidence that the European Union could also maybe negotiate trade terms with Donald Trump and simply avoid tariffs. Plus the French PM, Mr. Bayrou, is expected to survive a no confidence vote today, and so he could adopt a budget plan for France. Such outcome would actually further narrow the German-French yield spread and hence encourage a further recovery in the euro's valuation, though the upside potential in the euro is seen limited by the European Central Bank. Those that actually bet that the bloc's central bank will have no choice but to protect the bloc's back, as Donald Trump's threat and his tariffs won't go away overnight. Note that the euro-dollar options were actually implying a 13% chance of spot price touching parity within a week, and a 1 in 3 chance of spot touching that 1-to-1 mark within a month as early as Monday. Now, the bets are more encouraging this morning, obviously, than they were on Monday's trading session just after the Trump tariff shock, but the downside risk and the euro dollar outweigh the upside risk at this moment, due to the Trump tariff threats, due to the dovish European Central Bank expectations, and the continent's gloomy growth outlook. In the US, the S&P 500 and Nasdaq 100 consolidated gains above their 50-day moving averages on relief that Trump's tariff tantrum quickly fizzled out, and also on the back of lower than expected job openings report in the US that was released yesterday, and that hinted that after big increases in the recent months, the trend is back toward softening. And a softer job openings data from the US hints at softer pressure for higher wages and potentially a more supportive Federal Reserve policy. As such, the US yields eased yesterday and the US dollar softened across the board. The euro dollar regained the 103 mark and cable actually approached the 1.25 psychological resistance. Now, traders will be focusing on the US ADP report and ISM data that are due later today. The thinking is always the same. A set of softer than expected figures from the US could further pull the US dollar lower, unless, of course, Donald Trump pops up and says or tweets or posts on his media platform something that would trigger immediate capital flows into the US dollar. On the equities front, well, note that sentiment this morning is much less cheery than it was yesterday, as Google and AMD results that were released yesterday after the bell didn't necessarily enchant their investors. Now, Google announced better than expected earnings per share, but they announced a slight miss on their revenue growth. More importantly, growth in Google's cloud was just 30% last quarter. That's lower than the 32% expected by analysts and slowing. Because note that the cloud revenue at Google, or the cloud revenue growth at Google, has been slowing since the 2021 peak, where it stood near 54%. And the combination of slowing cloud revenue and massive AI investments, which will reportedly reach 75 billion US dollars at Google this year, raises a few eyebrows among its investors. By a few eyebrows, I actually mean a 7% drop in its share price in the after hours trading as a reaction to the latest results and that massive 75 billion US dollars spending. AMD, on the other hand, posted better than expected earnings and revenue in the fourth quarter. Its data center revenue nearly doubled last year, but alas, it still fell short of analyst expectations. And, well, you know what missing expectations means for a company's stock price, right? Here, it meant a nearly 9% drop in AMD's stock price in the after hours trading. Ouch. As a result, this discontent with Google and AMD results is quite weighing on the US futures. This morning, they are trading in the negative at the time I'm talking here, along with Trump risk, of course, and all the worries that, comes with Donald Trump and his international policies. Note that investors may be looking more relaxed now than they did at the start of this hectic week, but havens continue to see increased demand, obviously on the back of growing global uncertainties under Donald Trump's hectic lead, and with the prospects that the first weeks under Donald Trump's presidency is, just a quick foretaste of what's to come in the next 4 years. And there is obviously not a better hedge, I'm telling you, than gold for protecting a portfolio from Donald Trump waves and threats and risks, because the more hectic the international relations, the more demand for gold, if nothing, from the global central banks, including the EM central banks that want to limit their exposure to US assets in case Trump points his finger towards them. Consequently, gold hit a record high this week for the fourth straight session and traded at $28.60 per ounce level in Asia for the very first time in history. And I can, simply tell you that Trump makes the $3,000 level seem like an easy target. In energy, U.S. crude tipped a toe below the $71 per barrel level on de-escalating tensions with Mexico and Canada, but recovered some of the early losses on Donald Trump's renewed pressure on Iran. While the geopolitical risks with Donald Trump remain obviously tilted toward the upside, while Trump's trade policies are looking bad for global growth prospects, and the latter should actually keep the medium-term upside potential in oil limited. So, in numbers, top sellers are expected to join in between $73 to $75 per barrel range in US crude to try a fresh attempt on the $70 per barrel psychological support in the foreseeable future. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.